Hello and welcome to Gold and Silver Assets. It's Sunday, the 14th of June 2020. Last week we talked about hyperinflation and the horrors that are associated with that. So this week I thought we would look at the other end of the spectrum, and so that's deflation. Now I'm sure most of you will have heard those theories about how deflation might drag the gold price down to sub $1,000 levels. But what evidence do we actually have for that as a possibility? Is deflation really bad for gold? The first thing that I've noticed when listening to different commentators on this topic is that deflation can have different meanings to different people. So a common definition of deflation is a fall in the prices of goods and services. And this would be indicated by a negative consumer price index, or CPI. But prices can fall for a variety of reasons, and it's not always a bad thing. So, for example, if prices fall because of increased productivity and efficiency, then that might be due to technological advances, and so that's usually associated with economic growth. So that would be considered a good form of deflation. However, if prices fall due to a decline in demand, and that's associated with lower wages and higher unemployment, then that's a bad form of deflation. Others refer to deflation as a decrease in the money supply or a decrease in the amount of available credit. Some might also think of deflation as a drop in the price of assets, such as the stock market or real estate. But remember, it's possible for assets to deflate while goods such as fuel or food can inflate in price. The other important thing to remember is that deflation is different from disinflation. So disinflation just means a smaller amount of inflation. So prices are still rising, but by smaller amounts. So this is a fantastic chart showing the history of inflation in the USA over the past 300 years. And you can see that for centuries there have been wild swings between inflation and deflation. In the early 1700s, you can see that there was a large amount of deflation. It went to greater value as minus 20%. Whereas in 1740, it went as high inflation as around 37%. In the two depressions that occurred in the early 1900s, deflation went down to about minus 10% in both cases there. And we can also see that since 1950, we've essentially been in an inflationary environment. So what happens to the price of gold when CPI drops? Well, we haven't seen any big drops in the CPI since 1940, as we can see in this chart. But before that, there were 3 periods of deflation. So let's have a closer look at those. In 1810 to around 1850, the CPI dropped 60%. And over that time, the price of gold rose 3%. If we look at this period here, from 1920 to the mid-1930s, CPI dropped 32%, whereas gold increased by 69%. Of course, remember that the price of gold was fixed by the government at that time. But we do have an interesting period over here, which started in the 1860s. And at that time, CPI dropped 47%, but interestingly, gold also fell by 51%. So let's take a closer look at what's going on there. So this is a chart of gold priced in US dollars from 1862 to 1878. And this was the time of the Civil War, where the government needed more cash to pay for the war. And rather than pay high interest rates for foreign loans, they decided to issue a fiat currency, which they called the greenback. And these were made legal tender and were not backed by gold or silver. And while they were issued in increasing amounts between 1861 and 1815, you can see on this chart that the gold price steadily rose. Now remember, this doesn't mean that gold had become more valuable. It was more that it was a reflection of devaluation of the greenback. So when the war was finally won in 1865, the US Treasury actually began selling gold in exchange for the issued greenbacks, just as they had promised. And they did that until every single dollar had been redeemed. And as a result, the greenback went back to match the initial gold price. Now, this doesn't really, to me, sound like something that would happen in this day and age. If the government were try to pay back all the issued dollars in gold, I don't think there's enough gold to cover it at current prices. However, one option would be to reprice gold to enable that to happen. So what if we consider deflation to be defined as a decrease in the money supply? Well, many of you will have come across this chart, which shows the total monetary base in USA, shown in the blue line, and the gold price shown in the orange line. Both have been indexed to 100 in 1975. And from this chart, we can see that there's no clear-cut relationship between the two variables. So, for example, in 2013, you can see that there was a big increase in the monetary base, and yet gold price actually dropped. That's the reverse of what we'd expect. So the monetary base alone isn't the whole story, and we need to consider other factors. But the other interesting thing that I noted when I was looking at this chart was that when we do this indexing, you can see that the scales are different for the two variables, and so that's why we've got two sets of y-axis there. And what this does is that it makes it easier to compare the two in terms of their directional relationships, but it's not a direct comparison quantitatively. I therefore went back to the Federal Reserve website and rescaled the graph as shown here so that we can directly compare the two quantitatively. And this is really interesting. This shows that in 1980 the gold price increased to a greater extent than the monetary base. However, since the 1990s, that relationship has switched. The monetary base continues to increase at ever increasing paces, and this bit here has been pretty scary if you think about it, and yet the gold price has increased at a much slower pace, and so the gap between the two is steadily increasing. It could be said that the velocity of money is just as important as the size of the monetary base when considering inflation or deflation. So let's take a look at that. The velocity of money is shown here in blue, and we can see that since the late 1990s, the velocity has been steadily decreasing. However, this clearly hasn't been enough to offset the increase in the money supply, because the gold price has continued to rise over that time. Therefore, I think that when the velocity does turn around and move upwards, this is likely to be rocket fuel for gold. Some people talk specifically about asset price deflation occurring. And if this happens, what effect could that have on the price of gold? Well, on this chart, if we look here, we can see that between 1973 and 1975, there was a drop in the stock market. So the Dow had dropped about 46% over that time. Initially, gold was rising, but as that drop, kind of in the middle of that drop really, the gold price also dipped, but it promptly turned around and shot up. Similarly, in 2000 and in 2008, gold seemed to drop in the early stages of the Dow bear market. So we can see the drop associated here and also over here. However, in both cases, the gold price rebounded sharply well before the Dow had bottomed. So overall, my impression, at least over the past few decades, is that gold seems to drop slightly in the early stages of a stock market drop, but then it seems to just turn around and shoot up well before the stock market bottoms. That seems to be the pattern that we're seeing here. What about deflation in house prices? So this chart shows the Case-Shiller US house price index compared to the gold price. And we can see that there's not really any clear relationship here. Initially, both gold and house prices went up. Then house prices took a dip from around 2007 to 2012. But over that time, although gold had a small dip in between, it just kept storming upwards. And so I don't think we can really link house prices to gold prices. So let's go back to our original question. Is deflation bad for gold? Well, based on what we've seen in the preceding slides, I think the answer is no, not necessarily. I haven't been able to come up with any convincing evidence that deflation is bad for gold. If you have any reasoning to explain why it could be a problem for gold, please comment in the description. I'm always interested in hearing alternative views. But from what I've seen so far, I'm thinking that sub 1,000 gold is a low probability. Next up, the market update. So let's start with looking at the gold priced in US dollars on the daily scale. And it's been a pretty ho-hum week in terms of the precious metals. What we're seeing is this sideways movements and basically prices just going up and down within this range here. Where do I think price is going from now? Well, there's no actual indications from the price movement at the moment. We basically seem to be moving in a sideways channel, and that can break out in any direction. If we see a break above 1760, then we'd be looking for further upside targets of 1800 or possibly above that. However, a break below around the 1660 level, that would give us a breakdown towards, I would say, the middle of this channel line, which has been support in the past. So we're looking at around 1610, 1620 kind of level. I don't know which direction it's going to break out, but I would probably go for the downside just based on what I'm seeing in other charts and markets. Looking at silver priced in US dollars on the daily scale, and we can see that we hit upside resistance at around 1850, and price again is consolidating in the $17 to the 1850 kind of range. And we'd seen that price had been moving in this upwards sloping channel, and we're basically waiting to see if the lower end of that channel breaks. So we're looking for a break below around, let's say, the 1720 level. If that holds, then I would expect further upwards movements. It just doesn't feel like it's quite ready there, but I don't think we're too far off a break above that $19 level. Now remember that I look at longer time scales, so I don't mean that that's going to happen next week. But remember, we have been in this long-term sideways movements for silver for quite a few years now, and bear markets only last for so long. It might not feel like it, but there is a limit to how long bear markets can last. So I'm thinking that if we do get a break of this lower channel line, which I think is likely, then we'll be looking at a drop to the $15 range. But I think that $15 area would provide a reasonable amount of support. Moving on to the GDX, and we've been talking about this for a while, where we had broken out above that 32 resistance level here, and that had held as resistance for about 7 years. So this was a positive sign, but I remember that I was suspicious of it for a few reasons. One was that the volumes were low during this breakout, and also we do have some outstanding gaps below, and so that was just making me a little bit wary. And what we did see was this turnover, and again we're going back for a second time to retest that 32 level, and that's an important level to remember. What are we seeing here? Now, it's always possible that we could bounce off of that again, and I think if that happened, that would be very bullish for the miners. But again, I'm a bit skeptical because it kind of is looking like a head and shoulders pattern. And if that's the case, that would give us a target of around that 24 level down here. And if price were to drop to that level, that would very nicely close the previous gaps, and that would make things very tidy. Whether price goes below 24 remains to be seen. I think we just have to wait and see what price action does after that. But anything below that I would consider to be pretty good bargain territory, and I'm doubtful things will go below the 17 or 18. I think that would be my lowest level before a turnaround, but we can't be sure. Anything can happen in the markets, and certainly anything below 16 is rock bottom bargain prices. So why do I say that I think gold and the miners might be dropping? The reason that I think that is if you compare the GDX with gold. So the gold price is shown in bars and the GDX is shown as the blue line. And I've done this chart on the 4-hourly scale and basically overlaid the two. And the thing you'll notice here is that in the past few trading sessions, gold has been moving up, whereas the GDX has been moving down. And so that's a divergence, and the miners are usually the ones that precede the moving gold. And so that's what makes me think we're in for a little bit of a down leg. But let's see what happens next week. So that's all from me this week. Hope you're all doing well. All the best, and see you next week. Don't forget to like and subscribe. Bye.